One of the 5 ways to start investing with even $100 that I talked in a previous video is investing in ETFs. Exchange Traded Funds or ETFs are an easy way to begin investing. They are fairly simple to understand and can generate impressive returns with no much expenses or effort. In this video, you'll learn in detail about ETFs, how they work, and how to buy them. Hey there, Stockspert here. On this channel I share with my experience and educational videos on personal finance and investments. You can find my other videos on the channel's page and you may want to subscribe for more in the future. And if you haven't made any investment yet, make your first investments right now. Invest your click into the like button and I'll do my best to return your investment with quality insights. So what is an ETF? Exchange Traded Fund or ETF allows investors to buy many stocks or bonds at once. Investors buy shares of ETFs and the money is used to invest according to certain objective. For example, if you buy an ETF of S&P 500, it means that you invest in 500 companies in that index. You might have also heard of mutual funds. And the common question is how ETF differs from mutual funds, as the basic principle is the same. The key difference between the two types of investments is how you buy and sell them. Mutual funds are priced once a day and you typically invest a set dollar amount. Mutual funds can be purchased through a brokerage or directly from the issuer, but the key point is that the transaction is not instantaneous. On the other hand, ETFs trade just like stocks on the major exchanges such as the New York Stock Exchange and Nasdaq. Instead of investing a set dollar amount, you choose how many shares you want to purchase. And because they trade like stocks, ETF prices fluctuate continuously throughout the trading day and you can purchase whenever the stock market is open. Before we get any further, here are important concepts that you need to know before buying ETFs. There are two basic types of ETFs. Passive ETFs, also known as index funds, they simply track a stock index such as the S&P 500. And active ETFs hire a portfolio manager to invest their money. The key takeaway, passive ETFs want to match the index performance, while active ETFs want to beat that index performance. Also, ETFs charge fees, which is known as the expense ratio. You'll see the expense ratio listed as an annual percentage. For instance, 1% expense ratio means that you pay $10 for every $1,000 you invest. And all things being equal, lower the expense ratio will save you money. And most ETFs pay dividends. You can choose to have your dividends paid to you as cash, or you can choose to have them automatically reinvested through a dividend reinvestment plan, or DRIP. I bet you wonder how much money do you need to be able to invest in ETFs. ETFs don't have minimum investment requirements, at least not in the same sense that mutual funds do. However, ETFs trade on a per share basis, so you'll need at least the current price of one share to get started, unless your broker offers an ability to buy fractional shares of stock. And talking about fractional shares, eToro investing platform allows you to buy fractional shares, so if you are interested in this investing platform, I'll do the sign up link in the description. You can check out and trade ETFs and stocks at zero commission. Everything has pros and cons and ETFs aren't exception. So here are advantages of ETFs. The one is ETFs provide exposure to a variety of stocks, bonds, and other assets, typically at a minimal expense. The second is ETFs take the guesswork out of stock investing. They allow investors to match the market's performance over time, which had been historically quite strong. In comparison with mutual funds, ETFs are more liquid, which means it is easy to buy and sell. Online brokers make it even easy to buy or sell ETFs within a click of a mouse or tap of screen in case of mobile phones. And it can be extremely complicated to invest in individual bonds, but a bond ETF can make the fixed income portion of your portfolio very easy. And the potential drawbacks of ETFs can be the following. Since ETFs own a diverse assortment of stocks, they don't have quite as much potential as individual stocks in returns. And the second is that the ETFs are low cost, but still they aren't free. If you buy a portfolio of individual stocks on your own, you won't have to pay any management fee. In case of ETFs, you pay the expense ratio. If you decided investing in ETFs, here are 3 steps to do it. The step 1 is opening a brokerage account. You'll need a brokerage account before you can buy or sell ETFs. The majority of online brokers now offer commission-free stock and ETFs trades. So does eToro, by the way. So cost isn't a major consideration. The best course of action is to compare each broker's features and platform and choose the best fit for you. Step number 2 is choosing your first ETFs. For beginners, passive index funds are generally the best way to go. Index funds are cheaper than their actively managed counterparts, and the reality is that the most actively managed funds don't beat their benchmark index over time. With that in mind, here's a list of ETFs which track indexes and sectors of the stock market. The most popular ones is probably the ETFs which track S&P 500, such as Vanguard's S&P 500 ETF and Spider's S&P 500 ETF Trust. Here their tickers, they track the largest US 500 companies. The next one is Invesco QQQ Trust Series 1, which tracks the Nasdaq 100 companies with top holdings of Apple, Amazon, and Microsoft. So there are tons of ETFs which track real estate, high dividend ETFs, small cap ETFs, mid cap ETFs, and so on. You might just Google and find the best fit based on your investment style. And step number 3, just let your ETFs do the hard work for you. It's important to keep in mind that ETFs are generally designed to be maintenance-free investments. Newer investors have a bad habit to check their portfolios every day, like every hour. So do I actually, which can lead to make emotional knee-jerk reactions to major market moves. In fact, the average fund investor significantly underperforms the market over time, and overtrading is the main reason. So just keep calm and check time over time how your ETF is doing. So once you buy shares of some great ETFs, the best advice is to leave them alone and let them do what they're intended to do, which is to produce excellent investment growth over long periods of time. Here's a playlist about investing for beginners where you can get to know about what is the stock market, how does it work, how to get started investing, and all that. Just click on it and it'll change your life from now on. And of course, make sure to subscribe to the channel, hit the bell, like the video. See you in the next video.